Please pause the video until you have completed tasks 5 through 7 in the student guide, updated the return in TaxSlayer for the expanded case, and checked your return against the answer sheet. So for the expanded case, there was a change from the prior information. Specifically, we're going to assume for the expanded case that the taxpayer checked that she had both dividend and interest income, and we do in fact have a 1099 INT and 1099 DIV. So for the expanded case, we're going to enter those. As I mentioned, hiding over here on the left, if I move my pointer over there, is the menu, and the 1099 div and INT go into the federal section. So we click on that. We're already in the income by default. INT and divs are in the same section. We click on begin. Interest and dividend income are in the same section, so we click on begin. And now we have a choice of the specific form that we want. The first is a 1099 INT, so let's click on here and click continue, and there's the form. And it turns out there's only two things I need to enter on this form. There's a payer name up here at the top, Navy Federal Credit Union, and there's the interest amount, which is $95 rounded down. I do not need to enter the taxpayer TIN or EIN. Notice there's no red asterisk here. I do not need to enter the payer's address here. I do not need to pick the state. I do not need to do anything else in any of these other boxes because they're all blank. And this information up here, the taxpayer, about the payer, is not required in California. There are some states that require this information to be collected on the state return. California is not one of them. So here's another opportunity to save time by not entering this information from the form, not spending your time, not spending the taxpayer's time. So we put the two pieces of information in we need, because it's a very simple 1099 INT. Scroll down to the bottom here, it's a long way down. Click continue, and we've saved that form. So now we're here on the grid page, and we want to add another interest or dividend. This time it's going to be a dividend statement. We click continue, and here we are in the dividend. So again, we put in the payer's name, we skip all of the stuff in between, payer's EIN and address and state, and now we're going to enter whatever is the dollar amounts that are on the DIV form. In this particular case, there are 3 of them. Ordinary dividends are $100.49. We round down to 100. Qualified dividends are $89, rounded down from $89.11. And capital gains distribution is $25. So we'll put that in there. Scroll down to where we can click on continue and save. And finally, for part 2, I want to show you one other way of comparing your return to the answer sheet. So let's go back to that summary, scroll down to that summary print page, and you have the option of viewing printing the return, which really means that you can generate a PDF, which you have the choice of sending to the printer. I'll talk about that in a moment. So let's click on that, and it generates a PDF. Actually, it comes up and says, here's an opportunity to generate. Now this says print your 2021 tax return. That is a misnomer. That actually, again, will generate a PDF. It will not send something to your printer. So let's click on that. And you get a separate screen that has your 17-page return. So you can expand this. There's a plus here, 110, 125%. Let me start by saying I strongly recommend against printing this if you get to the point where you need to print a return for the taxpayer, because if you do, you're going to print a lot of extra pages, which you're either going to have to give to the taxpayer and that's potential confusion, or you're going to have to shred. So there are other ways to print a taxpayer copy that have a lot fewer pages than just the pages you need. The pages you need for the answer sheet, if we scroll on down here, bypass all of that information, images of the 1099-R, the forms that the taxpayer needs to sign to authorize us to electronically file. We finally, on page 7, get to the senior version, because the taxpayer in this case is over 65. We get to the senior version, and there are some numbers here that you can check against the answer sheet. So this is an alternative to using those pages, the summary print pages that we talked about. So let's see, I'm not sure how I get back to this. I guess I go here to summary, and that gets us back to the normal, what we normally see with summary print. So this concludes part 2 of the Alizinga video. In the expanded case, the taxpayer had given roughly $5,000 to one of her children. The question is, what if it had been significantly more? And specifically, what if it had been more than $15,000? The reason we're talking about $15,000 is because if a taxpayer gives more than that amount to a person during the year, the good news is they don't owe any gift taxes on that. It doesn't change their tax return. The bad news is that requires a form which is out of scope for Tax-Aide. Specifically, a gift of over $15,000 requires filing Form 709. And if you look in the scope manual for Form 709, you'll see it down at the bottom of this screen here. You'll see that it is marked no, not being in scope. You could still do a return of this type if it were for a close friend or for a family member or for yourself, but otherwise you can't. You're unlikely to run into this situation. It's a fact that you might want to tuck away in case you encounter it in some unusual set of circumstances. But this is an example of something that could be out of scope, something unusual, of course. You may have noticed that while none of the taxpayers' 2020 Social Security income was taxable, in the core case for 2021, some of it was, and in the expanded case for tax year 2021, even more of the Social Security benefits were taxable. So how fast does that increase? So what specifically, if 2021 interest income was $1,000 higher, how much more of her Social Security benefits would be taxable? So the best way to see what an extra $1,000 of income will do is to put $1,000 of income in. Before we do that, however, let's make a note of what the taxable amount of Social Security is before we add that extra income. That's $1,543. That's box 7. And let's just, for ducks, take a look at the amount of taxes that the taxpayer has to pay before we add the $1,000, and that is $948. I should say what the amount of the tax is, not what they have to pay, since they have some withholding. So $948. Okay. So let's go back to the menu here, Federal Section. And the easiest way to add $1,000 is just go into Interest and Dividends and change this. So we'll edit that. And let's go down to the interest thing, and instead of $95, it's going to be $1,095. Scroll down to Continue to Save. And now let's go take a look at, we could do this off the refund summary, but I didn't note what those numbers were. So let's go back to the summary print page. And actually we couldn't figure out the Social Security taxable from that. So Social Security taxable is $2,043, which is $500 exactly more. So adding $1,000 of interest income resulted in adding $500 of taxable Social Security. Up to 85% of Social Security can be taxable if there's enough other income. And that $1,500 of additional income, if we go to page 2, resulted in a tax of $1,118 versus $948. So that's $170 increase. So in some sense, you could say that $1,000 of additional interest income is taxed at a 17% marginal tax rate because it's dragging Social Security benefits into the taxable column. So one further comment's worth making. Low-income taxpayers, those who are lower-income taxpayers, those who are in the 10 to 12% tax bracket, do not pay taxes on qualified dividends, and they don't pay taxes on capital gains. However, if they go and sell, let's say, $5,000 of stock, if they sell stock and generate $5,000 of profit, because it's only the profit that is considered income, that $5,000, although it's not going to be taxed directly, is going to drag a whole bunch more Social Security into the taxable column. So when you haven't entered the stock dividend proceeds yet, and you look at the refund, the return summary, you do not want to assure the taxpayer that, oh, this isn't going to have any impact if there's Social Security on the return and it's not already taxed at 85%, because it will have an impact. And the other place you tend to see that is gambling winnings and losses. If you have somebody who has a lot of gambling winnings and a lot of gambling losses, they sort of offset each other because you can itemize and claim the gambling losses on your itemized deduction. However, it's not a complete offset because, again, those gambling winnings can drag an awful lot of Social Security from the non-taxed category to the taxed category. What if the taxpayer said she'd like to keep more of her money during the year and, of course, receive a smaller refund, and she asks you how she could do that? First, this is an uncommon question. Most of the time taxpayers are happy with how much they get. If they're getting a large refund, often they plan around that for a large purchase or just to put into savings. But sometimes it's possible they might ask how to get more of the money during the year and get a smaller refund. So the answer, of course, is generally withholding. Sometimes if there is a difficulty doing withholding, then estimated tax payments are the other possibility. That's generally undesirable. Besides the cost of mailing 4 quarterly payments, the taxpayer needs to remember to do that. Then the following year, you as a preparer need to get that information from the taxpayer and make sure that the taxpayer, if you can, really made those payments. In short, it's much better to have a withholding amount on a tax document like a 1099-R than it is to push the taxpayer in the direction of estimated tax payments. If the taxpayer is getting Social Security withheld, then one option is to change or start withholding federal taxes from Social Security. That's done on a form W-4V. You would need to print that out for the taxpayer. That's not part of TaxSlayer. And notice that you have only 4 choices for withholding percentages: 7, 10, 12, and 22%, and no California or state option. But generally the easiest thing to do if the taxpayer has wages or some sort of retirement income on a 1099-R is simply to suggest that they call whoever the paying organization is, the employer, the trust company, whatever, and ask them to increase the federal and or state withholding. This is a very, very routine request. The taxpayer taxpayer should know that this isn't a big deal. They probably talk to that company, their employer, once a year because they may be changing withholding. So just give them a call and tell them what they'd like for withholding. Of course, it will start in the middle of the year, so you have to do perhaps a little tweaking, but it's generally best just to figure out what your final point is, assuming you had 12 months of withholding an extra $100, for example, and not worry about the fact that if you're doing the tax return in March, you're only going to get 8 or 9 of those $100 extra withholdings occurring during tax year 2022. This concludes the Tax-Aide California Shared New Counselor Training, case number 1 for tax year 2021, Alizinga. You're now ready to move on to case number 2.